Welcome back to the Million Dollar Strategy series, where we decode how high income earners, especially those making over $1 million a year, structure their wealth under the big beautiful tax bill. In today's video, we are diving deep into one of the most misunderstood and most powerful tax saving framework for top earners, multiple entity optimization. By the end of this video, you will know exactly how to design a structure where every dollar you earn has a job, every entity has a purpose, and every tax move has documentation behind it. This is not theory. I will walk you through the new rule under the Big Beautiful Tax Bill, officially known as the One Big Beautiful Bill Act, or OBBBA, some example from 2025, and then step by step how you can build your own version before 2026. So if you ever wonder how do the wealthy decide which company earns the income and which one tax the deduction, stay with me because this one video will connect all the dots. Here's the roadmap for what we will cover today. 1. What changed under the Big Beautiful Tax Bill. 2. A real millionaire story from Chicago and how she cut her effective tax rate by 8 points. 3rd, the 5-step strategy you can start using in 2026. 4th, long-term planning for life after 2026. 5th, audit red flags and how to stay safe. 6th, final tax away and some mindset shift. Alright, let's jump right in. Now let's talk about what changed under TLB3, which is part 1. Before we dive into tactics, let's get clear on the landscape. The Big Beautiful Tax Bill made several structural clarifications that directly impact how high earners can move money between entities. Now, this isn't about creating shell company. It's about building a legitimate ecosystem where you decide where income lands, where deductions go, and how profit flow between companies. Under sections 162 and 482, intercompany transactions are allowed, but only if they are real, documented, and at arm's length. So, what's the news under Big Beautiful Tax Bill? The IRS has reaffirmed that related party management fees, IP licensing, and cost allocation are deductible as long as they are ordinary, necessary, and properly priced, meaning one company can invoice another you own, but the paper trail must prove real value was exchanged. And the 20% qualified business income deduction, the famous QBI, has now been made permanent. So if you are a high earner running multiple pass-through entities, you now have more flexibility to optimize that deduction, as long as your structure makes sense and your documentation is airtight. So that's the foundation, the legal framework that supports this strategy. But it's one thing to hear about it and another to see it in action. Let's look at how one real client applied these principles and completely transform her tax picture. So in part 2, we're going to explore the story on Stephanie in Chicago. So Stephanie is a marketing entrepreneur from Chicago. He was pulling about $2.4 million a year through her S-corp. So this is somewhat a case study that I want to tell you. So she restructured her business just before filing her 2025 tax return. So before we step in and deep dive, everything she owed, her marketing agency, her online courses, and even rental property were inside one S-corp. The result is messy books, inconsistent QBI deductions, and unnecessary audit exposure. She was paying an effective rate about 35%. So we want to break it down step by step how her situation can be handled. First, we can separate her income stream. So we can create operating S-Corp Inc. for her main marketing operations and employee wages. Then we can create another LLC, maybe name it Branding LLC, to own her intellectual property and license it to her agency. And finally, a real estate holding company LLC to hold her office lease and rental properties. Then we added intercompany agreements. Like say Branding LLC charge her S Corp for brand strategy and consulting services. Real estate holding company collected rent for the space and that the S Corp used. The S Corp reimbursed legitimate share expenses through an accountable plan. We documented every transfer with invoices, receipts, and time block. By doing that, we create a legitimate deduction that move income to the right entity. Now, and that is important, her S Corp still pay her a reasonable salary, about $200K to meet IRS compensation standards. But by routing the rest of her profit through documented intercompany fees, she dropped her effective rate from 35% to 27%, saving $180K in just 1 year. So Stephanie's story shows what's possible when structure meets strategy. Now let's zoom out because I want to show you how you can follow the same roadmap. Now let's move to part 3, which is the 5-step strategy for 2026. If your income exceeds 1 million or you are approaching that level, this next season is for you. Let's call it your 5-part blueprint or multi-entity optimization. And as we go, I will pause after each step to explain who this applies to and how you can implement it. Step 1, you want to separate the activities. This is the cornerstone. So never mix active operations, consulting, and asset ownership in the same company. Each one deserves its own entity. Why? Because it lets you isolate risk, track profitability, and direct income intentionally. If your operating business is where the work happens, keep it in your S Corp. If you have intellectual property or brand assets, put them in a management or a licensing LLC. And if you own property or equipment, park those in a holding company. You also want to separate bank account. You want separate books and separate agreements always. Step 2, charge management or service fees. Now here's where the optimization happens. If your management or licensing entity performs real services, it can charge your operating business a fee, and that's deductible to one company and income to the other. Here's how you do it step by step. 1, strap a service agreement that defines exactly what's being provided. 2, benchmark the pricing. Use comparable market data so it meets the arm's length standard. 3, send invoices monthly or quarterly and pay via bank transfer, so no vague journal entries. 4, keep copy of invoices, contract, and deliverable. So this step creates documentation and make the structure defendable under Section 482. Step 3, use an accountable plan. Now, this step is often overlooked but incredibly powerful. An accountable plan lets you reimburse share expenses like travel, subscription, or workspace across entities without creating taxable income. You want to write a formal accountable plan policy for each entity. You want to collect receipts with who, what, where, and why for each expense. Reimburse within 60 days. Return any excess amount. This is your secret weapon for making sure every expense stays deductible and compliant. Step 4, allocate owner wages wisely. If you are an S Corp owner, your salary is the dividing line between that what tax as employment rate and what qualify for QBI deduction. You want your compensation to be reasonable, meaning it matches what someone in your role would earn but not excessive. Use third-party wage data to justify it, then pay the rest out as profit so it's qualified for the 20% QBI deduction. Remember, underpaying yourself is gaming the system and is a red flag. The IRS looks for a fair ratio between wages and profit, so document your rationale. Step 5, maintain real agreement and records. This is where most people split up. If your entity don't have contract, invoices, and separate bank accounts, the IRS can characterize everything as one business. You want to keep each entity QuickBooks file separate, keep your books reconciled monthly, and perform your own mini audit each quarter. You want to ask yourself, would this hold up in court? If you treat your entity like separate business, the IRS will too. So what the 5-step system that $1 million earner are using in 2026 to bring structure, compliance, and tax efficiency into harmony? Let's look forward, because real wealth isn't about saving once, it's about planning for the next decade. Let's move into part 4, where we plan beyond 2026. This is where the elite earners pull ahead by designing multi-layer entities that protect, grow, and transfer wealth. Let's walk through 4 advanced moves that build on everything you have learned. 1. Build a family management company. Use it to employ family members legitimately. Assign roles, set fair pay, and document hours. This teaches financial literacy and shift income within the family. Add a C Corp subsidiary. A C Corp can retain earnings at a flat 20% rate. That means you can reinvest without triggering personal taxes immediately. Think of it as your reinvestment engine. 3rd, leverage state residency rule. More passive entities to low tax state, but only if you truly operate or managing them there. Don't fake residency. Document when decisions are made. 4th, integrate estate planning early. Have your holding company owned by a family trust. This lets you start the wealth transfer clock early, protect assets, and lower estate exposure long term. These are moves that take time to set up, but done right, they turn your structure into the legacy framework that can last decades. But before you rush to set all of that up, let's talk about what not to do. The red flags that can make even a perfect looking structure fall apart. So let's move to part 5, where we talk about red flags. Here's our 5 things that make the IRS instantly suspicious of multi-entity setup and how to avoid them. First, no contract or invoices. If you can't show what one company is paying another for, it's not a business expense. 2, personal expenses in business account. Every dollar needs a purpose. Personal dinner and vacations don't qualify. 3, identical ownership percentage with no business logic. If every entity is owned exactly the same way, it looks like duplication, not strategy. 4th, circular cash flow. Don't move money back and forth without a reason. The IRS sees it as round tripping, a common audit trigger. 5th, shared account or sloppy bookkeeping. So no shared bank account, no shared QuickBooks file. Separation builds strength. What is our bottom line here? If your structure wouldn't survive an internal audit at a Fortune 500 company, it won't survive the IRS. So how that we have covered the red flags, let's close with the mindset that ties all of it together, because the tactics only work when you think like an architect, not a taxpayer. So let's move to part 6. We want to share with you some closing thoughts. So as the $1 million at your level, your tax rate isn't just about your bracket, it's about your structure. The big beautiful tax bill made something crystal clear. Documentation and design are the new deductions. You can't control the tax code, but you can control your framework. When you divide, document, and delegate your income across entities, you can control, protect, and have peace of mind. If you are a business owner or investor earning over $1 million, now is the time to map out your structure before your next filing season. Because once the year ends, your flexibility ends with it. So plan early, act intentionally, and remember, wealth isn't built by accident. It's engineered one entity at a time. So to recap, here's your 6-part map. First, understand what changed under the big beautiful tax bill. 2, we learn from Stephanie's case study. 3, we follow the 5-step strategy to celebrate, separate, document, and optimize. 4, we plan beyond 2026 with long-term structure. 5, we avoid red flags that attract audit. 6, we adopt the millionaire mindset when a structure equals saving. That's how the wealthy don't just make money, they keep it, grow it, and pass it forward. Thank you for watching. I'm Mia. Like, share, and subscribe, and I'll see you in the next video update.